Good morning, everyone. Welcome back to the class Project Feasibility Study and Management. This week is the week 10. The main topics of week 10 is the concept of financial statement. However, this PowerPoint, that is the 10.2, the core concept of a balance sheet is one part of the week 10, the concept of the financial statement. For the slide 10.2, the core concept of a balance sheet, I would like to introduce you to know the concept of a balance sheet because the topics of week 11 should be pro forma financial statement that is included the pro forma balance sheet. Because you are tentatively being a new business startup entrepreneur, right? Before you start your own business, you need to forecast the financial positions of your business. As a result, on week 11, you are required to develop pro forma balance sheet for the next 5 years to access your financial stability as well the capital structure of your business. What I expect from students as the learning objective after you complete the topics of the core concept of a balance sheet as the PowerPoint 10.2. First, I expect students understand the definition of balance sheet. Then, I expect students can explain the purposes and usefulness of a balance sheet as the second and third learning objectives. Fourth, I expect students can describe the concept of a balance sheet that assets equal liabilities and equities. Finally, I expect students can identify the components of a balance sheet that are first one, asset, second one that are liabilities, and the last one should be equities. As a result of the learning objective, I then introduce you the definitions of a balance sheet, the purpose, usefulness, concept of a balance sheet, and the component of a balance sheet. Well, shall we, right? We will start from the definitions of a balance sheet. On the slide number 5, right? What is a balance sheet? Here you are. The balance sheet is one of the main financial statements that show the financial positions at a specific point in time. I said that a specific point in time. What does it mean, right? The balance sheet usually at the end of a month, such as 31st of the January 2025, end of quarter, such as 31st of March 2025, or at the end of year, that is 31st of December 2025. This time frame are different from the time frame of an income statement. Here, the time frame of an income statement are, for example, 1 month, 3 months, or 12 months, not as at the end of the period. Shall we move to the purpose of a balance sheet? On the slide number 7, I show you the purpose of a balance sheet. First one, the balance sheet, right? The purpose of the balance sheet is to show the financial positions of the business. The key message, the keyword is the financial positions. The balance sheet provides a snapshot of assets, liabilities, and equity on a specific date. The balance sheet will help the business owner like you, right? Or the investor or an creditor to see how strong or weak of the financial positions of your business. The second purpose that is the monitor liquidity and solvency of the business. To measure liquidity is the ability of your business to pay short-term debt. You can use the current asset like cash or receivable. In order to measure the solvency of the business, how to do? To measure the solvency is the ability to meet the long-term obligations. You can use the total asset and equity. Balance sheet monitor financial health of the business, whether the business can pay the short-term debt as liquidity bills and can meet the repayment the long-term debt. Third one, for the third purpose of the balance sheet, that is the evaluate financial stability and capital structure. What it is? The balance sheet will show you how the business is financed. The business is financed by debt, or your business is financed by your owner equities. A high debt to equity ratio may give you the sign as the higher financial risks, while a higher equity ratio suggests you have more stability. So for the fourth purpose of the balance sheet, that is the support the decisions making for the business owner, for the investor, or for creditors. The business owner use the balance sheet to manage the finance here, right? The usefulness of the balance sheet. For the usefulness of the balance sheet, for business owner and the management team to identify financial strength and weakness, and to plan the resources allocations and future investment, as well to support the business owner to monitor debt level and working capital needs. Shall we move to the concept of the balance sheet? Here you are, the key concept of the balance sheet. I show you the fundamental accounting equation that is the key concept of a balance sheet, that is assets equal liabilities plus equity. We move to here the component of a balance sheet. Here the component of a balance sheet that are comprised with assets, liabilities, and equities. Firstly, we will start with the asset. What are the assets? Assets are defined as anything that the business owns and can be converted into cash. For example, on the slide number 15, for example, cash are the current asset, as well inventory are the current asset. Last one is the factory, is the fixed assets. All here that I provide you on this slide is the asset. Again, an asset is defined as anything that the business owner owned, right? And can be, the keyword here, can be converted into cash. So the component of the assets, there are two types of the asset here as the slide number 16. In terms of the assets, we categorize assets into two categories. that are first one, current asset, and second, that is the non-current asset or the fixed asset. So here, how we can categorize the asset into current asset or non-current asset or the fixed assets. The concept, I mentioned that the concept is that if you can convert the asset into cash within 1 year, such as cash is cash, right? Such as cash or cash equivalent, or might be account receivable, inventory. We categorize these assets like current asset because of the concept of the current asset, that is the any asset that you can convert to cash within 1 year. On the opposite side, any asset that you cannot convert into cash within 1 year, such as factory, land, building, we categorize these assets like non-current asset or fixed asset. Here, in terms of the current assets, such as cash and cash equivalent, marketable security, account receivable, inventory, and prepaid expenses. I will give you the foundation, the background, the concept of the account receivable that is categorized as the current asset. What is the account receivable? Account receivable here is a current asset on the balance sheet that represents money, right? Money that your customer not yet paid for good or service. But, right, you are the business, you are the entrepreneur. You already deliver good and service to the customer. But the customer not yet paid the money to you for good or service. We call this transaction as the account receivable. Here, the second key term, that is the prepaid expense. What are prepaid expenses? The prepaid expenses are payment made before you get benefit. The business, right? You are the business, you expect to receive the benefit later. So until that happened, these expense are considered as an asset, not an expense. Shall we, right, move to the non-current assets? The non-current asset on the slide number 20, right? The non-current asset include long-term investment or the fixed asset that cannot be converted into cash within 1 year. The keyword is that cannot convert into cash in the short term within 1 year. At this point, right? Okay, for example of the non-current asset or the fixed asset are, for example, land, buildings, factory, equipment, patents, trademark, brand, goodwill, intellectual property. Well, at this point, we complete the assets that are current asset and non-current asset. We then go to the second component of the balance sheet, that is liabilities. Here, the liabilities. What are liabilities? On the slide number 22, liabilities are financial and legal obligations that you need to return, you need to repay to the creditor or the debtor, or it might be the money that you need to return to the bank. In terms of the component of the liabilities, so there are two types of liabilities that are first one current liabilities and the second one that is the non-current liabilities or long-term liabilities. Here you are the concept, right? The concept of the current or non-current liabilities are first one, if that liabilities you need to return or to repay to the creditor within 1 year. The keyword is the within 1 year are categorized as current liabilities. On the other hand, if the liabilities that you can return or you can repay that liabilities less than 1 year or in the following year, we categorize that liabilities as non-current liabilities or long-term liabilities. So shall we deep down right into the current liabilities? As I mentioned in the previous slide that current liabilities refer to any liabilities that business need to pay to debtor or creditor within 1 year, right? For example, on this slide, the slide number 24, I provide you for example of the current liabilities that are account payable, short-term debt, interest payable, accrue expenses. In terms of the interest payable, what does it mean? It means that the interest that you not yet paid to the creditor or to the bank or to the debtor. As well, the accrue expense on the fourth bullet point. For example of the accrue expenses. For example, salary payable, rent payable, utility payable. What does it mean? The accrue expense. That is the expenses that you not yet paid to the creditor or to the debtor. We call all here like a salary payable, rent payable, utility payable as the accrue expense. As well, the other accrue expenses within 1 year, we categorize here as the current liabilities. In terms of the account payable, I'm not sure are you still have the basics concept of the account payable. I then provide you, right, refresh you this knowledge that what is a account payable in particular. The account payable here is the current liabilities on the balance sheet. The account payable represents the money, right? Money that you are the business, do not yet paid to, for example, do not yet pay the money to the supplier or to the vendor for good or service that the business have been received but not yet paid for. What are the non-current liability or the long-term liabilities? The long-term liabilities are obligation or debt that the entrepreneur, that you, right, you can repay or return in the next following years. For example, here, like a long-term debt or the bond payable. In the case of long-term debt, please imagine that when you start your business, you borrow money from a bank, for example, 1 million Thai baht. You promise the bank that you will return 1 million Thai baht to the bank within 5 years. It means that you need to return money to the bank, for example, 200,000 Thai baht every year for the next 5 years, right? Therefore, the 200,000 baht will be recorded as the current liability since you need to return the 200,000 Thai baht to the bank within 1 year. We categorize as the current liabilities, right? And the remains, right? The remain principal of 800,000 baht will be recorded as long-term liabilities since you can postpone the repayment of 800,000 Thai baht to the next following years. So the last one, that is the equity. We move to here. Owner equity is also called shareholders' equity. In the time of the sole proprietorship or the partnership, is called owner's equity. But in the form of corporations, we call this part as the shareholder equities. At this point, we complete the liabilities that are current liability and long-term liability, right? Okay, we then move to here the last part, that is the owner equity. That's as I give you the explanation that the owner equity, that is the last part of the balance sheet. Here you are the component, right? The component of equity. The main component of shareholder equity, the share capital, is the amount invested by shareholder. There are two types of the share capital, such as here, common share. Second, that is the preferred share. In terms of the common shareholder have voting right and claim on profit. However, the preferred shareholder have priority in dividend payment and liquidation, but limited on voting right. And here the third one, that is the retained earning. It is the one component of the equity part. The retained earning. What is the retained earning? In the bracket, right? I provide you that the retained earning is the accumulated profit. What does it mean? Here, the retained earnings are the accumulated profit. Retained earnings are profit that the company or the business has earned over time and not yet distributed as the dividend to the shareholder. The retained earning can be used for expansions of your business or can be reserved to pay to the shareholder as the dividend. If right, okay, please pay attention to what I'm saying. If you are in the first year of your business of the balance sheet, the balance sheet should not be contain retained earning, because retained earning is the profit of your business in the previous year. Here you are, the example of the balance sheet. On this slide, I provide you an example of the ABC Corporation balance sheet. The main concept of balance sheet is that assets equal liabilities and equity, right? From this example, the total asset of the ABC Corporation is the 2.23 million Thai baht, as well as the liability and equity of the ABC Corporation equal total asset at 2.23 million Thai baht. The concept of the balance sheet, we start the balance sheet with the asset, followed by liabilities and equity. In particular of asset, we classify the asset by the type of the asset that are current asset, followed by long-term or fixed asset. In terms of the liabilities comprise of the current liabilities and long-term liabilities. The current assets are sequenced by liquidity that are cash and cash equivalent, followed by account receivable, inventory, and prepaid expense. You then sum up the row that is cash and cash equivalent, that the row number 1, 2, 3, and 4, right? Here you then get the total current asset. After that, you sum up the row number 6 and 7 that are land and building and machine and equipment. That is the long-term asset. You then sum up the total current asset and long-term asset. You will get the number of total asset 2.23 million Thai baht. I move to the part of the liabilities. We start the liability from the current liabilities that are account payable and short-term loan as the row number 10 and 11, right? You continue sum up the long-term liability as the loan number 14 and current liability, you will get the number of the total liabilities that is 1.23 million Thai baht. Here you are the last component of the balance sheet is equity, right? Equity shareholder. The common stock shareholder and retained earning here. In this case, you are the first year of the new business startup, right? You then did not have any profit in the previous year. Therefore, you have a 0 Thai baht retained earning. Finally, you sum up the total liabilities and equity. You will get the total liabilities and equity as the row number 18 at 2.23 million Thai baht, which equal the total asset that is 2.23 million Thai baht as well. Here on this slide, I provide you the differences between an income statement and a balance sheet. Please notice here that an income statement shows you the revenue, show you all expenditure and profitability of your business over a period of time, such as over 1 month, over 3 months as a quarter, and over 12 months as 1 year. While balance sheet show you what business own in terms of assets, liabilities, and equity at a specific point of time, such as at the year end on 31st of December 2025. At this point, I already introduced you and share you the concept of a balance sheet.